Roughly half of all S&P 500 options volume now expires the same day it's traded. As of 2024, 0 days to expiration contracts went from a niche curiosity to the single biggest slice of the options market. And most of the videos you've seen frame them as a get-rich button. Before we go further, this is educational commentary, not personalized financial advice. I'm going to show you the mechanism, not a magic trade. Because once you understand who is actually on the other side of your 0 DTE ticket, the whole game looks different. Let's define it cleanly. A 0 DTE option is any contract entering its final trading day. On SPX and SPY, there's an expiration every single weekday, so you can always buy something that expires in hours. The pitch is seductive. Tiny premium, huge percentage moves be done by the closing bell. A contract that costs $40 can triple in 20 minutes. That's real. What's also real is that it can go to zero in the same 20 minutes. And unlike a longer-dated option, there's no tomorrow to bail you out. Here's why this matters right now. The explosion in 0 DTE isn't retail gamblers alone. A large share of the flow comes from institutions using these contracts as cheap, precise hedges and as tools to harvest premium. When you buy a lottery-style call, you are frequently trading against a market maker and a systematic seller who do this thousands of times a day with a statistical edge. You're playing one hand. They're playing the whole deck. That asymmetry is the core of everything that follows. Point 1. The math of buying 0 DTE is brutal because of theta and probability. An at-the-money option that expires today has almost no time value left, so decay isn't gentle, it's a cliff. Think about a simple at-the-money contract with maybe a coin flip chance of finishing in the money. To profit as a buyer, you don't just need to be right on direction. You need the move to be big enough and fast enough to beat the premium you paid and the decay eating you every minute. Being right and still losing is the normal outcome, not the exception. Let me make that concrete. Say SPY is at 500 and you buy the 500 call expiring today for $1, $100 per contract. For you to double, SPY roughly needs to push through 502 with time to spare. If it drifts sideways for an hour, that same option might be worth 40 cents even though the price barely moved against you. You were basically flat on the underlying and down 60% on the position. That gap between being right and getting paid is where most accounts quietly bleed out. Point 2, the sellers have a structural edge, but it is not free money. Selling 0 DTE premium, say a credit spread or an iron condor, wins on most days because most days the market doesn't move far. You collect small, consistent premium. The catch is the shape of the payoff. You win a little often. You lose a lot rarely. One trending afternoon or one surprise headline can erase a month of small wins in a single position. The edge is real, but it's an edge that punishes anyone without strict risk limits. This is the part almost nobody says out loud. Both sides can be losing strategies if you size them wrong. The buyer bleeds from decay. The naked seller blows up on the tail. The people who actually make money over time are not picking a side because it's exciting. They're the ones treating 0 DTE as an instrument with a defined, capped risk on every single trade and a position size small enough that the worst-case loss is survivable and boring. Point 3, so who actually makes money? First, the market makers who aren't betting on direction at all. They pocket the bid-ask spread and hedge their exposure continuously. Volume is their friend, and 0 DTE brings enormous volume. Second, disciplined premium sellers who use defined risk structures and cap the tail. Third, hedgers who use 0 DTE to protect a larger portfolio cheaply. Notice what all three have in common. None of them are trying to hit a home run on a single contract. And who consistently loses? The trader treating 0 DTE like a scratch ticket, buying cheap out-of-the-money calls into a rally, holding for the double, then watching decay and a stall wipe the position. That trader can win 4 times in a row and feel like a genius, then give it all back plus more on the 5th. The percentage swings are so large that a couple of full losses undo a long streak of wins. The dopamine is real. The equity curve trends down. Point 4, understand what the options market is actually pricing in before you touch these. The expected move for the day is baked into the premium. If implied volatility says the S&P will move about 0.6%, then a strike far outside that range is cheap for a reason. It's cheap because it probably won't happen. When you buy those far strikes hoping for a miracle, you're not finding a bargain. You're paying the crowd's fee for a low-probability event, and the seller is happy to keep collecting it. Point 5, 0 DTE changes the market itself, which loops back onto you. Because so many dealers are hedging these same-day options, Their hedging can amplify intraday moves near big strike levels, especially in the last hour. That means the afternoon can accelerate in one direction faster than the fundamentals justify. If you don't respect that, you get caught buying the top of a squeeze right before it reverses. The instrument you're trading is partly creating the volatility you're trying to profit from. So here's what a disciplined trader actually does. They decide the maximum they can lose on a trade before they enter, and they treat that number as already spent. They favor defined risk structures over naked exposure so a single headline can't detonate the account. They size so that 10 losses in a row is an annoyance, not a catastrophe. They check the expected move and refuse to pay for miracles. And critically, they log every trade, because the only way to know if you have an edge is a sample size, not a good Tuesday. The honest summary is this: zero DTE options are neither a scam nor a shortcut. They're a fast, cheap, high-resolution tool that rewards process and punishes emotion faster than almost anything else you can trade. The people making money are usually the ones who find them a little boring. If that reframing was useful, subscribe, because we break down what the options market is really pricing in every week in plain English. Trade the process, not the adrenaline, and protect your capital first.